The Economics of Fallen Empires, the $39 trillion debt analysis. The American financial ledger just hit a staggering milestone, $39 trillion in total obligations. To put the gravity of that figure in perspective, the United States is currently draining roughly $1.2 trillion every single year just to cover the interest. That isn't chipping away at the balance or paying down the principal. It is a pure fee for the privilege of owing money. It's a sum that dwarfs our national defense budget and outstrips our total spending on Medicare. Here at the Economic of Fallen Empires, we track the patterns of collapse, and this trajectory is perhaps the most predictable one in history. This interest burden is poised for a violent surge because over the next 36 months, $9 trillion of older debt is reaching its expiration date. These loans were secured when money was essentially free, with rates near zero. Now they must be rolled over at 4 or 5%. When this transition is complete, the annual tribute to interest alone will skyrocket past $2 trillion, consuming over a third of every tax dollar collected by the federal government. The mechanics of the debt mountain. Throughout this deep dive, I will reveal the mechanics behind this $39 trillion mountain and why. From a purely mathematical standpoint, it is a debt that can never be settled. We will examine the exponential acceleration of this crisis, the way it chokes the life out of economic expansion, and the inevitable fallout for your bank account, your career, and your family's future when this fiscal pressure cooker finally bursts. The reality is that traditional repayment is off the table. The numbers simply refuse to add up. When a sovereign nation reaches this point of no return, it faces a trio of grim choices. A default that shatters global trust, austerity that induces a massive depression, or inflation that liquefies the value of the currency. The engines of the printing press are already being primed, and your personal prosperity is the fuel. Historical dereliction of duty. To grasp why this momentum is now unstoppable, we have to look back at the historical dereliction of duty. In 1980, the debt sat at a relatively modest $980 billion, with a debt-to-GDP ratio of just 35%. It was manageable. However, the subsequent 4 decades saw a bipartisan abandonment of fiscal sanity. The 80s brought massive military expansion and revenue-slashing tax cuts, pushing the needle to $2.8 trillion. The 90s offered a brief moment of calm, but by the turn of the millennium, the floodgates opened. Between the war on terror, unfunded entitlement expansions, and the massive bailouts of the 2008 banking collapse, the debt surged to $10 trillion. The 2010s saw this climb to $23 trillion through continued stimulus and military spending. And came 2020, the year the brakes failed. Emergency COVID injections, trillion-dollar infrastructure bills, and student loan maneuvers accelerated the total to the $39 trillion we see. Today, in early 2026, the interest rate feedback loop. The danger isn't just the sheer volume of spending. It's the shift in the interest environment. For over a decade, the Federal Reserve kept rates in the basement, allowing the government to borrow with almost no consequence. But as inflation took hold in 2022, the Fed was forced into the most aggressive rate hiking cycle in modern memory. Now that $9 trillion in cheap debt is being refinanced at more than double the cost. This creates a lethal feedback loop. Every year, we have to borrow more just to pay the interest on what we already owe. By 2030, we could be looking at $2.5 trillion in annual interest, over 40% of all federal revenue going to bondholders instead of citizens. At the Economic of Fallen Empires, we recognize this as the death spiral phase of a currency. Why growth cannot save us. Can we solve this through growth? The math says no. For a country to outgrow its debt, the economy must expand faster than the debt itself. Currently, the U.S. economy grows at a real rate of 2 to 3%, while the debt is expanding at 7 to 10%. You cannot win a race when your baggage is getting heavier 5 times faster than you are getting faster. This leaves us with the 3 exits I mentioned earlier. A default would be a nuclear option for the global economy, as the U.S. dollar is the bedrock of international trade. If the U.S. stops paying, the global system stops working. Your retirement accounts, the functionality of the military, and the very stability of the streets would be at risk. This makes it a path most leaders will avoid at all costs. The path of least resistance. Inflation austerity is equally unpalatable. To actually balance the books, you would have to eliminate the entire military and still cut Social Security by 20%. No politician will vote for their own career suicide by stripping benefits from the electorate. This leaves us with the final, most likely path: inflation. This is the hidden tax. The government monetizes the debt by having the Federal Reserve create digital money to buy its own bonds. This floods the system with dollars, making every dollar you currently hold worth less. We saw a preview of this between 2019 and 2022 when $5 trillion were printed, resulting in a 20% spike in the cost of living. Your paycheck didn't shrink, but its power did. The human cost. As this spiral tightens, the impact on your life becomes a suffocating reality. You will face higher taxes, not for services, but to pay interest to foreign creditors. Public infrastructure will continue to decay as the budget is cannibalized by debt service. Your life savings will be eroded by a persistent, government-mandated inflation designed to make the national debt smaller in real terms at your expense. This is intergenerational theft on a scale that would make an empire blush. The survival plan. So, what is the survival plan? If the path is inflation, your defense must be hard assets. This means moving away from dollar-denominated paper and toward things the government cannot print: physical gold, silver, scarce digital assets like Bitcoin, and real estate. It means investing in your own skill set expertise that maintains value regardless of the currency's strength. While the masses will wait for a rescue that isn't coming, the proactive few will reposition their wealth into productive, international, and tangible holdings. Conclusion: the math is clear and the clock is ticking. Within the next 5 to 10 years, this fiscal imbalance will reach a violent resolution. The economic of fallen empires exists to help you navigate these transitions before the curve goes vertical. If you want to understand which specific assets thrive during a currency debasement and how to shield your family from the coming $50 trillion milestone, subscribe now and hit the notification bell. Our next analysis will provide the blueprint for building an inflation-proof portfolio. The printing presses are warming up. Make sure you aren't the one holding the bill.